My guest today is Ashmi Mehrotra, Global Co-Head of the Private Equity Group at JP Morgan Asset Management. With a focus on small and mid-market companies, the JP Morgan Private Equity Group, or PEG, manages $30 billion in assets under management and is one of the longest-standing PE firms in the industry with a 40-year-plus history. Now, Ashmi has spent the majority of her career in this alternatives asset class, and we're so pleased to welcome her to Beyond 60/40. Ashmi, it's great to have you here today. Thanks so much for joining us.
Thank you.
Well, you've obviously been in private equity for a while, and in fact, the group that you're now co-heading, you actually started there about 20 years ago. So you've really seen the whole evolution of the whole growth. So talk a little bit about the approach that you take to private equity investing, and specifically, I know that there's 3 areas of focus for you, which is co-invest, which is secondary transactions, and also primary investing into GPs as well. So what's the approach?
Well, thank you so much for having me. So yeah, we invest in those 3 types in terms of areas in private equity. One is primary, where we're investing in an underlying GP's fund. We do that in early stage VC funds as well as small and mid-market buyout funds on a global basis. On the co-investments, we're focused on small and mid-market co-investments, and we define that as companies that are under $1.5 billion in enterprise value. And on secondaries, we're active both on the LP side and the GP side in terms of GP-led and LPs, but we do more LP secondaries and primarily on the buyout side.
Got it. And so that's good that you're able to cover sort of the entire market spectrum. And so with that, let's talk a little bit about your outlook for 2024. What are the top 3 areas of conviction that you have that you know you're going to be doing this year?
One is on the LP secondary side. There continues to be high quality assets available in the market, on the secondary market, particularly in mid-market buyout funds that are available at discounts of, call it between 5 and 20% of net asset values. Now, just because something is cheap and at a discount doesn't mean it's good. You have to we do our diligence, very thorough diligence on each of the underlying companies within those funds. But you can buy into high quality names that are more mature portfolios that should have a shorter harvest period, right, in terms of exits. And we believe there's going to continue to be good performance and level of activity and deal flow in that area. The other thing we like for this year is co-investments, where we are seeing high quality direct companies that are available on the small and mid-market size alongside a small and mid-market buyout sponsor. And because fundraising has slowed and the cost of capital has gone up, there is oftentimes more equity needed to consummate those transactions. So GPs are looking for like-minded investors that can be in their funds as well as co-investors alongside them. And so we continue to feel good about, number one, what we've deployed there, but also the deal flow coming this year. And then on the third side, what we like also is early stage venture capital. Venture capital is an interesting entry point now because valuations have compressed across the industry over the last couple of years. And what's not changed though in venture, as you know, is the technology disruption. That's not going away, right?
Yeah.
It's only increasing, and the technology adoption is increasing. And so we feel because valuations are down and the overall macro landscape continues to be very good in terms of disruption, it could be an interesting entry point for venture as well.
Right. I mean, when I think about venture and where it's been in 2021 and 22, we were at really elevated peak valuations. For example, late stage venture valuations were really sky high. They've corrected some, but can you put some more numbers around that? How much of a valuation correction are you seeing in venture that's making it attractive?
Many of those companies haven't actually come back to raise more capital yet. We expect that to happen the remainder of this year as well as next year. And so we will see continued valuation volatility in some of those portfolios because the GPs haven't taken some of those write-downs yet because they haven't necessarily needed to. Right? And some have been more proactive about it, some have not.
And the companies have not come to the market because they had enough funding to last this whole time?
Yes. Yep.
But that runs out.
Yeah, the cash runway, as we call it, or the cash burn overall, but the runway is really, because they raise so much capital, it can be 2, 3, sometimes 4 years.
Okay.
And there's a lot of focus now, obviously, on reducing burn anyway, so they've elongated those cash runways, and so you haven't seen as many of them come back yet.
But 2024 seems like might be the year when some of that will start to come back.
Yes, I think the second half of this year you'll see, you already seen a little bit last year, at the end of last year, you'll see more this year as well, but it will continue because there's a lot of different cohorts of them.
Right.
But on the early stage side, we've seen some decrease in valuation, although it's been a little bit more steady.
Right. But are we talking 30%? Are we talking 40%? Or what kind of discounts do you think we're seeing?
Probably 10% or so. It's not 30% or anything like that.
Right. The other thing that I thought you mentioned that was really interesting is that there are more private equity secondary deals available. So why are they more available? What's driving that? Is it still that denominator effect that we saw in 2021? Or why else would an LP be divesting of those stakes?
Yeah, so we saw the denominator effect definitely in 21 and even 22, and in 23 that's sort of changed, right? Because the equity parts of their portfolios and the fixed income parts of their portfolios actually increased significantly in terms of performance, and so it's less a denominator effect of what's driving the secondary market today. Instead, what's driving the secondary market is the lack of exits that LPs are experiencing in their portfolios. Because there are less sales that are happening across private equity. In fact, 2023 was one of the lowest years of distributions back to LPs.
Because there's no IPOs, M&A volumes have slowed down, no
and
exits.
there's continued to be less new deals getting done, right, in general, and so there's less exits therefore. And so because of that, LPs are looking to exit out of their existing private equity portfolios, rebalance, cull some of those older names that they want to sell that maybe they're not re-upping with, and create more capital available for the re-ups they're going to do this year or the new private equity commitments that they're going to do this year. And so that's driving more of the LP deal flow in the secondary market. And yes, they're obviously price sensitive, but at the end of the day, we're still seeing discounts of 5 to 20% on those buyout funds.
Right. And the last category that you talked about is co-invests. And I guess maybe talk about the discounting that you're seeing there. And are some of the co-invest deals that you're doing, are they being driven because finally the sellers are okay with the price that they're getting from the buyer, and maybe that buyer-seller gap is narrowing, or is it something else that's driving those volumes?
What's happened in the small mid-market, what happens in the small mid-market is most of these companies are family-owned businesses. They're looking to potentially access the private capital markets for the first time. Perhaps they have to, they have a succession issue, right, where there's, they need new management or more professional management, right, for the next stage of growth of their business. There's other aspects of the next growth stage of their business that they're looking to accomplish with a partner that has a lot of experience executing on that, whether it's operational improvements, supply chain, systems improvements, geographic expansion, sales and marketing expertise. There's all these different expertise that private equity can bring. And so it tends to be, they're obviously focused on price like everyone is, but they're not necessarily trying to optimize only for price. That's not the only thing that's driving their decision. There's all these other multitude of factors I talked about that's driving their decision ultimately of who they get to sell to within private equity and when. And so we continue to see good deal flow there, and we'll be active in deploying co-investments this year as well.
I guess let me ask you this one other question, which is about dry powder. There's $1.6 trillion of it. And I imagine you've heard this question a lot, which is there's record amounts of dry powder chasing few deals. What is that going to do to valuations? And does that actually diminish the potential for future private equity returns when you have this intense competition for deals?
It's a great point, and I've gotten that same question. I've seen this same, question asked repeatedly. And like everything, there are so many layers to this entire subject. But it's an interesting dislocation that's happened in the market, and we believe it's an interesting entry point. Therefore, so why is a dislocation? I talked about lack of exits. There's sellers. They're selling at discounts. There's co-investments available because leverage cost is too high and fundraising has slowed down. And so actually, instead of looking at this whole, painting this $12 trillion industry with the same paintbrush,
right,
we look at the different parts of it and where are the dislocations happening and where is the more interesting areas to get higher risk-adjusted returns going forward. And so we continue to feel good about where we are in the market in terms of small mid-market and the opportunity set there.
Ashmi, with that, thank you so much for the terrific perspective, and thanks for joining us today.
Thank you.